Did you know there are ways retirees can save on taxes? Yes, that's right. In fact, we are going to discuss 3 of these methods today. Navigating the world of taxes in retirement can sometimes feel like a maze, but fear not. Through the twists and turns, we're going to shed light on some strategies that could help you keep more money in your pocket. We'll be exploring the benefits of contributing to an individual retirement account, or IRA, using a health savings account, or HSA, and itemizing deductions for unreimbursed healthcare expenses. Each of these strategies has its own unique advantages, and understanding them could make a significant difference to your financial health in retirement. So without further ado, let's dive into the first method, contributing to an individual retirement account, or IRA. First on our list is contributing to an individual retirement account, or IRA. An IRA is a type of savings account designed specifically for retirement, offering tax advantages that can help retirees keep more money in their pockets. Here's how it works. When you contribute to an IRA, your contributions may be tax deductible, meaning you could lower your overall tax liability. But it's not just about tax deductions. The money in your IRA grows tax deferred until you withdraw it. This means the interest, dividends, and capital gains that accumulate over time are not subject to tax until you start making withdrawals. Now let's talk about the potential drawbacks. There are limits to how much you can contribute to an IRA each year, and if you withdraw money before age 59 and a half, you may face a penalty. Plus, once you reach age 72, you must start taking required minimum distributions, or RMDs, which are taxable. In spite of these potential drawbacks, the benefits of an IRA can be substantial. By contributing to an IRA, you can lower your current tax bill and allow your savings to grow tax-deferred, which can be a powerful way to build wealth for retirement. That's the first method. Now, on to the second method, contributing to a health savings account. The second method to save on taxes as a retiree is by contributing to a health savings account, or HSA. An HSA is a unique type of savings account that allows you to set aside money on a pre-tax basis to pay for qualified medical expenses. This means that the money you put into an HSA is not subject to federal income tax at the time of deposit. Contributing to an HSA can be a smart move for retirees for a couple of reasons. First, it can significantly lower your taxable income, which in turn can reduce your overall tax bill. Secondly, the funds in an HSA grow tax-free, and withdrawals for qualified medical expenses are also tax-free. Now, it's important to remember that there are some potential drawbacks. There are annual contribution limits, and you can't contribute to an HSA if you're enrolled in Medicare. But with careful planning, an HSA can be a valuable tool for managing healthcare costs and saving on taxes. That's the second method. Now, on to the third and final method, itemizing deductions for unreimbursed healthcare expenses. The third and final method we'll discuss is itemizing deductions for unreimbursed healthcare expenses. To itemize deductions is to list individual tax-deductible expenses on your tax return. These expenses can range from mortgage interest to student loan interest, to unreimbursed healthcare expenses. Now, what do we mean by unreimbursed healthcare expenses? Simply put, these are costs associated with healthcare that were not covered by your insurance. This could include things like prescription medications, surgeries, or even some long-term care services. For retirees, itemizing deductions for unreimbursed healthcare expenses can be a great way to lower your taxable income and thus save on taxes. For instance, if you had a significant amount of medical expenses in a year that were not covered by your insurance, you could potentially deduct these expenses from your taxable income. However, it's important to keep in mind that there are limits to this method. As of the current tax year, you can only deduct the amount of your total unreimbursed healthcare expenses that exceeds 7.5% of your adjusted gross income. And that's the third method. Now let's wrap things up. So to recap, we've discussed 3 ways retirees can save on taxes. First, we explored the benefits of contributing to an individual retirement account, or IRA, which can lower your taxable income. It's a nifty way to grow your retirement savings while also reducing your tax bill. Next, we dove into the advantages of a health savings account, or HSA. By setting aside money in an HSA, you can cover eligible healthcare expenses and diminish your taxable income in one fell swoop. Lastly, we discussed the potential savings from itemizing deductions for unreimbursed healthcare expenses. This strategy can be a game changer, especially for retirees who face considerable healthcare costs. But remember, these aren't just strategies to reduce your tax bill. They're about making the most of your hard-earned money during your golden years. They're about ensuring that you can enjoy your retirement to the fullest without unnecessary financial stress. Effective tax planning and saving strategies are crucial for retirees. They empower you to take control of your finances and live your retirement on your own terms. Remember, every penny saved in taxes is a penny earned. Thank you for watching and see you in the next video.